Yeah. So today we will discuss about the recording process and recording process in detail. In the last class, we simply saw some simple transaction of purchase and sale, payment of expenses, receipt of money from debtors, payment to creditors. Those were simple transactions. And we did not discuss about the rules of when a particular account should be debited or credited. Today in this class is actually for those candidates who are going to appear for ITI examination. In ITI examination, all the basic functions are to be studied in detail. No advanced chapter have been included in your syllabus. But in the case of examinations of ITO examinations, certain advanced chapters have been included in the syllabus. So today we are going to discuss certain typical difficult transaction along with the rules, principles of journalizing of recording transactions. And tomorrow's class will be for those candidates who are appearing for ITO's examination, wherein advanced chapter will be discussed. So from now on, the classes will be held on alternate days for ITI examination candidates and ITO examination candidates. So today's class is for ITI examination, wherein we are going to discuss in detail the recording function. So what is visible in the screen? Can anyone tell me?
Orange background.
Journal. Yeah, here we go. So basic accounting procedure. The first stage in the basic accounting procedure is that of recording a transaction. And transactions are recorded in a journal, in a register, which is known as journal. It is also known as book of original entry. The screen has been shared. And I think on the screen, basic accounting procedure and journal is clearly visible to all. And my audio is also clear.
Yes, sir.
Yes, sir.
Someone is trying to get in. Let me admit. Mr. 1 plus CPH 2467. Yeah, admitted. So for the purpose of accounting, for recording a particular transaction, we should first of all, we should be able to know the nature, the type, the kind of account which are involved in a particular transaction. So how many types of accounts are there? This thing is the first and foremost and most important thing. While we are recording the transaction, we think about which account will be debited, which will be credited. So first of all, we should know how many types of accounts are there. What are the different types of categorization? So types of account. Accounts are classified if we look at the broad category. Broadly, accounts are classified as personal account, real account, and then nominal account. All the three words are visible on the screen in color red color. Then there is sub-classification. Classification inside the classification. The personal account is again subdivided into three types. First one is natural, then artificial, then representative. Similarly, real account is also sub-classified into tangible and intangible real account. Then nominal account is also sub-classified into two categories: expenses, losses, and then income and gain. So we will discuss about these different types of account. how do we decide as to which account belongs to which category? This representative personal and intangible real will be discussed in my next class. Today we are discussing about natural, artificial, then tangible under the real category, and then expenses, losses, and income gain. So first of all, natural person account under the personal category. Personal account are related to persons. Look at the sentence. It says accounts recording transactions relating to individual human beings are classified as natural persons personal account. Natural means the thing created by God. The nature has been created by God. And we, the people, Mr. Ram, Mr. Syam, Mr. X, Mr. Y, these are also created by God. So these are known as natural persons. There are some examples here. Let's have a look at them. The first one is owner proprietor's account. Owner and proprietor of a business is definitely going to be a natural person. So account related to him, which is popularly known as a capital account, come under the category of natural person account. Again, some names of my student are written over here. Sanatan account, Hers account, Rohan account. They are also natural person. Again, some other students are Ganika account, Srishti account, Anya account. These girls are also natural person. Next, it's my name. I am also a natural person. Again, in some transactions, in some questions, you will find age account, B's account, or X account, Y account. These accounts are also known as natural persons account. So if any of these persons are involved in a transaction, for example, suppose the proprietor, the owner of the business is bringing cash or some asset into the business, or Mr. Sasi Sharma is paying cash to someone or receiving cash from someone, then one of the transactions, one of the account involved in the transaction will be a natural person account. So these are the category, these are the name of accounts which come under the category of natural person account. Now, the second category, subcategory. Can you see the screen? All of you are able to see the screen and written over there written
Yes, sir.
artificial personal account.
Yes, sir.
Okay. So now artificial personal account. So artificial is the word just opposite of natural. Everything that is man-made is known as artificial. So the sentence, the description says, the accounts relating to limited companies, bank, firm, institution, club, there can be some school also, hospital. These institution, association are formed by natural persons. These institutions are not formed or created by God. These are man-made and composed of some natural person. Some natural person, suppose if we take the example of bank, some natural person is the manager in that bank. Some natural person has been designated as chief accountant. There is a person known as peon or clerk. All these are natural persons. Similarly, in a school, we will find principal of the school, headmaster of the school, some teacher of the school. All they are natural person. But when viewed as a single entity, they are collectively known as school. Let's say DAV school or some other school. So these association, companies, bank, hospital, school, these are known as artificial person. And there can be transactions with this institution association. Suppose you have supplied 100 chairs and tables to a particular school. So definitely you are going to record this transaction in your books of account. If we take the example of a hospital, you might have supplied medicines worth rupees 50,000, 20,000, etc. to the hospital. It's a business transaction. And it will be recorded in your books of account. So in this transaction, an artificial person's account is involved. So the example of this type of account can be as follows: Punjab National Bank account or any bank account. Because every bank is composed of certain individuals. Then Bhusal is Steel Limited, Bhusan Steel Limited. Then Vedanta Aluminium. Both these companies are present here in Jharsuguda. They will be considered as artificial persons. Similarly, Women's College in Jharsuguda. Then again, a particular school in Jharsuguda. Then DAV school. These institution associations are known as artificial persons personal account. Now we come to the category of tangible real account. And that too, tangible real account. So which account are considered as real account? The sentence says the accounts relating to tangible things, not persons. And things which can be touched, seen, purchased and sold are known as real account, tangible real account. There can be many examples of such type of account, like goods account. Goods are not person. Similarly, machinery account, it is a thing, something which can be touched, seen. Then building account, yet another land account. Then cash account, the most important thing for any business, cash. Because without cash, no business can succeed. Cash is regularly either given to some people, persons, or are received from some persons by the business. Then motor vehicle account. All these accounts are not related to persons, whether natural or artificial. These are things which are usually purchased and sold by a businessman, which generally come into the business or go out of the business. If you are engaged in the business of real estate, then you may purchase building, you may sell building, and building will become goods in that case. And all these things can be touched or seen. There are some intangible things also, for which recording is done in our books of account. Intangible things which cannot be seen or touched, like goodwill, patent, then trademark, then certain license, certain type of know-how, knowledge of some person or goodwill of some persons, some business cannot be touched or seen. But these are also real account, come under the category of real account, but intangible one. So we will discuss about this intangible real account later on in detail. Let's stick to tangible real only for the moment. Next category is nominal account. Nominal account means accounts relating to losses, expenses, gains, and incomes. These accounts are neither related to any person nor related to anything. Just remember a simple rule we should follow if we are going to decide about the type of account. Whenever anything is mentioned in a transaction, and if that name, that thing is the name of a person, then it is a personal account. If the nomenclature name denotes certain things and not persons, then it is definitely a real account. And for the nominal category, it is the residuary head. If a particular thing or name mentioned in the transaction is neither related to a person and or nor a thing, then it will be nominal account. For example, salary. Salary word is involved in a transaction. You are paying salary to your staff. So just look at the word salary. Salary is not the name of any person, whether natural or artificial. Again, this salary is not a thing like furniture, machinery, cash, which can be touched or seen. So this salary will be a nominal account. There are other examples also. Let's have a look at them. Salary account, commission account, rent account, interest account, discount account, then bad debt account. All these names are not the name of any person, whether natural or artificial. No one keeps his name as Rent Gupta or Rent Sharma. Not the name of any person. Again, these are not things. You can't lift rent and put it on the table. You can't touch discount. These are neither the name of the person nor any kind of thing. So these are nominal account. So the simple rule for deciding about the type or category or kind of account, just think about it, that look at the name and then think about it, that whether there exists a man, a person or not. If a person exists by that name, then it is a personal account. If certain things exist by that name, then it is a real account. And none of these two, if there is no person by that name, there is no thing which can be touched or seen by that name, then it will definitely be a nominal account. So these are the three types of account. And under nominal account, there are two subcategories. The nominal account can be a losses, expenses, or incomes and gains. The point is, this salary account, is it a loss, expense, or a gain or income? So it depends on the transaction. If you are receiving salary from someone, you are working for someone, that the owner of that business is paying salary, monthly salary to you, or someone is giving commission to you, or you are getting rent for your certain property, then all these nominal accounts will be considered as income for you, because you are receiving money. And just on the other hand, if you are paying rent or commission or salary to your staff, then these are losses or expenses for you, and will then be treated accordingly. So the first thing is the type of account. Whenever we are going to record a transaction, you have to search for the names of account and their type involved in the transaction. Then you have to apply rules. You should know the rules for these types of account. What are the rules for debiting them or crediting them? So let's discuss about that. The rules. There are two kinds of rules. One is known as golden rules and then modern rules. Golden rules were prevailing in UK, whereas modern rules are followed in USA. First of all, golden rules were developed. Thereafter, modern rules were developed in USA. So let's discuss about golden rules. The golden rules for personal account are debit the receiver and credit the giver. If in a transaction a person is involved, then you have to see whether that person is the receiver of something or giver of something. If he is the giver, then his account will be credited in your books of account. And if he is the receiver, suppose you are selling something, you are selling goods to him on credit, then obviously he is the receiver of goods. So you will debit his account in your books. On the other hand, if you are purchasing goods from that person, then that person is the giver. Or you are receiving cash from that person. Earlier you had sold some goods to him on credit and now that person is paying cash to you. So that person is the giver. And his account will be credited. So there are two rules for every kind of account, every category of account. For personal account, debit the receiver, credit the giver. Similarly, for real account, there are two rules. Debit what comes in and credit what goes out. These are the rules. These two rules are related to things, objects. These are not the name of certain persons. So there can't be receiver or giver. The things will either come into your business or go out of the business. So the relevant rules are debit what comes in and credit what goes out. For example, suppose you are purchasing furniture for being used in your office worth rupees 10,000 or 1 lakh. Then furniture, look at the word furniture. Furniture is the name of a thing. And you are purchasing furniture. So furniture is coming into your business. So furniture account will be debited. Or suppose you are selling your motor car. Motor car which was being used in your business for transportation of goods. Then motor car is also a thing. And on being sold, this motor car is going out of the business. So motor car account will be credited. Now we come to the two rules relating to nominal account. The rules of nominal account say debit all losses and expenses. If you are paying some cash to someone, then it is an expense for you. Suppose you are paying cash to your servant, to the manager in your business. It will be known as salary. And since you are paying salary, it is a loss for you. Or we can say expense. Then salary account will be debited. Or if you are receiving commission from someone, then commission account will become income or gain and commission account will be credited. So these are the rules, golden rules developed in UK and we will stick to these rules while recording the transaction. You must memorize these rules. Otherwise, your recording may go wrong. So we discussed about the type of account, the nature of account, then the rules for debiting or crediting. Now let's see what exactly are the steps for recording a transaction. Or we can say, what are the steps for making a journal entry? And what is a journal entry? Journal entry is nothing but a record of a transaction in a particular register titled as journal book. When we record a transaction in the journal register, it is known as, that recording is known as journal entry. So what are the steps involved? The first step is, first of all, look at the transaction, read the transaction, go through the transaction, and select the two accounts, name of two accounts which are involved in the transaction. Step 2, decide about the nature of those two accounts, type of those two accounts, whether those two accounts, we are studying double entry system. Accounting is also known as double entry system. So always in a transaction, there will definitely be two accounts involved. There can also be 3 or more accounts, 2 or more accounts, more than 2 accounts, but not less than 2 accounts. In all the transaction, you will definitely find 2 accounts, at least 2 accounts. So search for the name of those 2 accounts, then decide about their nature as to under which category, whether personal or real or nominal, they fall. Then third step, decide about the rules. After deciding the type, suppose we decided that one of the account is a personal account. But the problem is, there are two rules. There are two different types of rules applicable for personal account. One is debit the receiver, another one is credit the giver. So which rule will be applicable to that personal account? So we have to decide about the rules, fix the rules applicable to these two accounts. Next step is decide about the debit credit. So if one of the account involved was personal account and he is the receiver, you will come to a decision that his account will be debited because he is the receiver. If there is a thing coming into the business, then according to the rules, it will be debited. That thing account will be debited. Say furniture. If you are selling the furniture, it's going out of the business. And in that case, furniture account will be credited. So simply there are 4 steps. So while recording a transaction, you must think about these 4 steps. And after some experience, these steps will automatically come into your mind. And your recording will be 100% correct. But we must practice these steps. So we will use these steps and see the application of these 4 steps in some transactions. Now we will learn about how to apply these 4 steps. Let's take certain transactions. 4 steps means 4 columns. We are not journalizing. We will see the format of journal and how the recording is done later on. We are just trying to analyze the transaction, understand the 4 steps that go inside our mind while thinking about the recording of a transaction. So first step, decide about the accounts involved. Second one, type of account. Third one, fix the rules applicable. Then debit or credit. So let's take some transactions. Here is the example of a transaction. Some businessmen, some business purchased for machine for cash, rupees 10,000. Let's see the words written over here. One word is purchase, another one machine, next 4, then cash. There are 4 words in this sentence. So we have to decide about the 2 names, 2 things. Which should be recorded in our books of accounts. So the 2 accounts involved are cash. Cash is the most important thing. Which is taken care of by every businessman. How much cash he is having, how much cash is being paid out, how much he has received from someone. Accounting of cash account is a must. Another word is machine account, machinery account. Then let's decide about the type. Can anyone suggest under which category these 2 accounts fall?
Real tangible, sir.
Sir, real account.
The real account.
Real account. Both are real account?
Yes, sir.
Okay, thank you. Very good. Both the names are actually real account. So we will write the category here. Cash is a real account. And machinery is also a real account. Now decide about the rules. There are 2 rules applicable to real account. Debit what comes in and credit what goes out. So in the case of cash account, the cash is going out of the business. So goes out. We will write goes out against cash. And against machinery, this machinery is coming into our business. So goes out, the thing going out of the business is always credited. And the thing coming into the business is debited. So finally, we have decided which account will be debited or credited. The main thing in this analysis is, the main columns in this analysis are accounts involve first column and last column. The 2 middle columns are actually will go inside your mind. You have to think about it. Finally, when we record an entry, record a transaction, then only cash account will be written and debit will be written against this account. We don't mention in our recording the type of account, the nature of account is not mentioned, and neither are the rules. You need not write the type of account or rules in the recording, in your recording, in passing a journal entry, in journalizing a transaction. Let's take another example. Received commission, rupees 200. What will be the name of 2 accounts involved in the transaction? Come on, speak up.
Commission and cash.
Commission and
Cash.
yeah, good, very good. Commission and cash. The two accounts involved are commission and cash. Cash account and then commission account. Cash account is a real account, but commission account is a nominal account. And what about the rules? Look at the transaction. Real account has two rules: debit what comes in, credit what goes out. In this case, the cash account, this cash is coming into our business. In the previous transaction, cash was going out. But in the second transaction, cash is coming into our business. So we will write comes in. And in the case of nominal account, it is an income or gain for the business. Because the cash is coming into, you are receiving cash. So it is an income. Comes in means, cash is coming in means it will be debited. Whereas commission being an income or gain, it will be credited. Once again, paid rupees 150 to hers. The name of two accounts.
Cash account and hers account.
Yeah, correct. Cash account and hers account. So here we are, hers account and cash account. Hers is the name of a person, a natural person. So it has been categorized under personal account. And cash is once again real account. The rule applicable in the case of hers is receiver. We are paying cash to hers. He is the receiver. He is the receiver of cash. And as far as the cash is concerned, it is going out of the business. And receiver is always debited. And the thing going out is always credited. Yet another transaction. Purchased goods worth rupees 1,000 on credit from Ganika. The two accounts involved will be
Purchase account and Ganika account.
yeah, right. Ganika account and
Purchase account.
purchase account. Ganika account and purchase account. Ganika is a personal account. It's the name of a person, natural person. And purchase. Purchase is nominal. You see, there is some confusion about this purchase account. Some author, writer, consider this purchase as a real account also. It depends upon the way we look at the transaction. When you use the word purchase and sales, then it definitely means some goods are coming into the business or going out of the business. So if we look at the word goods, then goods are real things which can be touched, seen, purchased, sold. But if you simply look at the word purchases, the purchase word, and we don't ignore the goods, then simply the purchase word will become nominal account. In whatever way you look at the transaction, the result will be same. If you say purchase is a nominal account, then it is an expense, it will be debited. And if you think about this purchase by way of goods, then goods are real things. And when you are purchasing goods, the real things are coming into your business. Then in that case also, purchases will be debited. So in this transaction, Ganika being the giver, she is selling us goods. So she is the giver. And purchase, which is a nominal account, is an expense for us. Giver is always credited. And purchase being an expense will be debited. So this was all about golden rules. We can see, analyze the transactions by using these golden rules and decide about the debit or credit. There are certain other rules also, known as modern rules. Modern rules can also be applied, can be used for journalizing a transaction. And just like in golden rules, we have had 3 different categories: personal, real, nominal. Here also, in the case of modern rules, first of all, we need to categorize the accounts involved in the transaction. And there are 5 categories according to modern rules. The accounts are classified into 5 different categories. Those categories are, or types, category or type of account can be of 5 different types. First one is capital. It means related to the owner, or it can be an asset. It can also be a liability or expense losses or revenue, incomes or gains. So first of all, like in the case of previous golden rules, we were classifying the different accounts under the personal, real or nominal category. But when we follow these modern rules, we have to classify the account under any of the 5 categories. And after categorizing, we have to decide about the debit or credit, whether debit should be given to that category, that account, or whether credit. So there are simple rules. Have a look at these rules. The rules applicable in the case of capital, liability, and revenue incomes are similar. So when capital, if in a transaction, if due to a transaction, the capital is increasing in our business, the capital is getting increased in our business, then capital account will be credited. And if capital is decreasing due to a transaction, then capital account will be debited. Same is the case with liability, revenue and income. If due to certain transaction, your liability is increasing, then credit that liability account if it is increasing. And if it's getting decreased, then it will be debited. And for the middle two categories, assets and expenses, the rules are similar and just opposite. In the case of assets, it will be debited if it is increasing and credited if decreasing. In the case of expenses, losses also, the rules of assets are applicable. If you are paying rent to someone, commission to someone, salary to someone, your staff, then your expenses are increasing month by month. Every month you are paying cash to your staff as salary. So your salary, your expenses are increasing. So whenever you make a payment towards salary, you will debit salary account. So these were the rules. Modern rules. The modern rules can be looked at differently also. The modern rules here are given in graphical format. We can easily memorize or understand the rules if we look at our hand. Denote your thumb by A. A means assets. Then middle three fingers will be called capital, liability, revenue gains. And look at the debit rules. If A and E, asset and expenses, are up, are increasing, then asset and expenses account will be debited. And capital, liability and revenues are down. These the middle three fingers are down, are decreasing. These three category of accounts are debited when they are decreasing. And in the credit rules, the picture is exactly opposite. If CLR, capital, liability, revenue gains, these three fingers are up, pointed upward, means increasing, then these accounts will be credited. And if assets and expenses are decreasing, they will be credited. So we will once again look at the same four transactions we discussed about in golden rules and see what will be the debit or credit for those the accounts involved in those transactions according to modern rules. And you will clearly see that result, the final result comes out to be same whether we are using golden rules or whether we are using modern rules. Let's see the first transaction. In the first transaction, machinery was being purchased for cash. The name of two accounts involved will be same as previously, cash account and machinery account. Now you will categorize these two accounts under any of the five categories. Cash will come under asset category. It is an asset for the business. Machinery is also an asset for the business. And just see which asset is increasing in the business and which is getting decreased. And it's very much obvious. Cash is decreasing due to this transaction because it is going out of the business and machine is increasing. So we will write decreasing against cash, decrease against cash, and increase against machine. And the rules applicable are, if an asset is decreasing, then it is always credited. And in the case of increase, the asset account is debited. So same result. By using the golden rules also, we arrived at the same debit and credit. Debit for cash, credit for cash, sorry, and debit for machinery. In the golden rules, the cash was a real account, was coming into the business. No, sorry, going out of the business. Since we are purchasing machinery, cash was going out of the business, real account going out of the business and was credited under the golden rules. And machinery also being real, it was coming into the business. So comes in, rule of comes in was applicable and machinery was debited under the golden rules. So final result will always be same. You can look at a particular transaction by using both the rules. A certain kind of cross-check is possible, cross-check. If both the rules are giving you the same result, then there is 99% possibility that your recording is correct. And please note that most important thing, most important of all is the recording. Out of the 4 major functions, recording, classifying, summarizing, interpreting, the most important one is recording. If your recording is wrong, your debiting or crediting of the account are wrong, then everything that we do after this recording will definitely go wrong. Because while classifying the transaction, you look at your recording and then post those transactions into different accounts. In yesterday's class, we first of all recorded certain transactions in cash book, in purchase book, sales book, journal. Then after recording, we looked at the cash book. How did we post the transactions from cash book to the ledger? The transactions recorded on the debit side of cash book were posted onto the credit side of the ledger account. Whereas transactions appearing on the credit side of the cash book were recorded on the debit side of certain accounts in the ledger. And suppose you make a mistake in recording the transaction in the cash book itself. Instead of debiting the cash book, writing on the debit side, suppose by mistake you record it on the credit side. Then your posting, your classification will go wrong. So most important thing in accounting is recording of the transaction. You must have heard about Tally software, accounting software Tally. Do you know what does Tally do? We just record the transaction, we make entry for transaction, and then classification, summarizing, etc. are done by the machine itself, by the computer itself. But if at the very outset, you have given wrong debit or credit to the computer, to the Tally software, then it's not going to make the correct classification or bring out a correct summary. So this was the transaction viewed according to the modern rules and the result were same. Now let's see the second transaction. Received commission. The two accounts involved were cash account and commission account. Cash account being an asset and it's increasing. Cash is getting increased in our business because we are receiving cash. And commission being an income is also increasing. But when asset increases, it is debited. And in the case of revenue, incomes, gains, they are credited when increase. When there is an increase in those revenues, income, gains. So here again, the result is same. Age was in the golden rules. Then again, paid rupees 152. Jatin or hers. It can be anyone. In this case, the name is quite different. Jatin account, cash account. Jatin is a liability. Because some goods, something must have been purchased previously. We might have purchased something from Jatin. And that's why we are paying cash to him. So we were liable. We had a liability towards Jatin. And that's why we are paying cash to Jatin. So after being paid, our liability will get decreased. And cash being an asset is also decreasing. So in this case, the liability called as Jatin will be debited and cash will be credited. And the fourth transaction. Again, the name also, in this case also seems to be different. Instead of Ganika, the name is Payal Bensandia. We are purchasing goods from a person on credit. And when you purchase something from someone on credit, you become liable to pay the amount to that person on a certain later date. Your liability getting increased. So Payal account is a liability for you. And purchase being an expense, liability getting increased, so it will be credited. And expense also increasing, it will be debited. So here we are. So we have studied two types of rules, the different types of account, the steps involved in recording a transaction. And always remember, you must practice these rules, make a practice, sufficient practice of these rules. Only then you can make a correct recording of transaction. And recording, let me say once again, emphasize the importance of recording. Recording is the most important function on which other functions depend. So these were the rules and types of account, debit, credit. Now we will see the format of journal. How do we actually pass the journal entry? So all the 4 transactions that we just discussed will be recorded in this format of journal. It contains 1, 2, 3, 5 columns. First one each for date, then particulars, then LF. LF means ledger folio, then debit credit. Under the date column, we will write date, then account which is being debited will be written first of all. And against this account, DR will be written. Then account which is being credited is written below the account that is being debited. and look at the words to cash account. Never start writing this to or cash below M. It should be at a distance, at some distance. This T, 2, should never appear here below M. It would be a wrong practice. So after debiting and crediting, we write a brief description of the transaction, which is known as narration, narration for the journal entry. And a short sentence about the transaction is written. In this case, the machinery was being purchased for cash. So we have written inside the bracket, being machinery purchased for cash. And then again, all the transactions after deciding about the debit and credit, we will write in this format. This format is used for making journal entry. The date, the name of the debit or credit account, then narration and respective amount are written in the amount column. So guys, that was all for today's class. I described certain transactions, and in the group, I will share some transactions which will actually be a homework for you. And then day after tomorrow, not tomorrow, day after tomorrow, I will discuss the homework that I will send you today. So never forget to practice the homework. Pass journal entries or make the 4-column table for those transactions. And make mistakes. Because if you don't make mistake, you are not going to learn anything. So make mistakes. I will discuss and elaborate upon the mistakes in our class. And the things will be fine. So well, okay guys. That's all for today's class. I will share the recording of this class in our group. I am ending the session now. Thanking you all.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you. Thank you very much.
Thank you, sir.
Good night. Good night,
night.
everyone.
Good night, sir.
Good night, sir.